Good morning. This is Dave Toth with an RJO MRT Technical Webcast update on the Mini Russell 2000, S&P E-Mini, and crude oil markets for Monday, January 24th. Starting off here with an intraday 4-hourly chart of the March Mini Russell contract, a developing threat to the equity markets in general, and also to some correlating markets like the crude oil market that are currently enjoying very positive correlations with the equity markets might be in jeopardy. Clearly, given the market's failure not only below the January 14th corrective low at 79.52, but the January 7th low at 77.40, and the impulsiveness of last week's failure in the Mini Russell really defines that last week's 80.99 high as one of developing importance. From a very short-term perspective, we have the developing potential for a bullish divergence in short-term momentum that we would not be surprised if it results in an interim B or second wave or right shoulder, if you will, corrective recovery. But while that 80.99 high remains in place as a resistant cap, so does the prospect of a much larger degree correction or reversal lower. For showing here on a daily log scale chart, the break of that 70.44 low from January 7th, in fact, breaks the longer-term uptrend. It confirms a bearish divergence in momentum and defines that 80.99 high as one of greater significance as far as a start of a larger degree correction or reversal lower. One thing we're sure of is that by virtue of this confirmed bearish divergence in momentum, we believe that 80.99 high completes a 5-wave Elliott wave sequence up from the November 16th low at 69.98, exposing at least a correction of that portion, that 2-month portion of the secular bull trend. And indeed, the market has nearly retraced 38.2% of that 2-month rally in just a few days. What we are unsure of from a much more dangerous perspective, looking at a daily close-only chart going all that shows the rally dating all the way back from the July 6th low at 58.96, is the prospect that this entire wave sequence, the January 18th high close at 80.82, completes a 5-wave Elliott wave sequence dating all the way back to that July 6th low, which, if correct, would expose a much larger degree correction or reversal lower that we think could very easily drive this market back down to the 73.50 to 72.50 range. That 73.50 area being former resistance, new support from November, and of course the 38.2% retrace, a Fibonacci minimum retrace of that entire rally around 72.50. In sum, a neutral policy as a result of the extent and impulsiveness of the past week's setback. We advise traders to move to a neutral sideline position for the time being, as the longer-term bull trend has certainly been threatened. And then if the market reinforces a broader peaking and reversal threat by proof of 3-wave corrective behavior on a subsequent recovery attempt, then we'll move to a more aggressive bearish position for a larger degree correction or reversal lower that could last for weeks and possibly months. And certainly that 80.99 high now serves as a terrific resistant cap and objective risk parameter. The market is now obviously required to recover above to mitigate any peaking and reversal threat and to reinforce the broader bull trend. Moving to the S&P contract, you can see that the market clearly has confirmed a bearish divergence in short-term momentum by virtue of the market setback last week below the 1272 area. But from a longer-term perspective, you can see that the market has yet to break below that January 7th corrective low at 1257.75 needed to confirm a bearish divergence in daily momentum that, like we just discussed in the Russell contract, would expose a larger degree correction or reversal lower and define last week's 1296 high as a much more significant high. So in this respect, shorter-term traders with tighter risk profiles have been advised to move to a neutral sideline position, but longer-term players, as the market has yet to break the longer-term uptrend, longer-term traders remain advised to maintain a bullish policy with weakness below 1257 required to threaten that enough to warrant moving to a neutral sideline position. From an intermediate term perspective, we think you can see Friday's rebound to last week's setback that defines last week's 1267.5 low as one of developing importance. And certainly if the market relapses below that last week's 1267 low, it will increase the odds that ultimately the market will be vulnerable to a larger degree correction or reversal lower below that key 1257 area. An issue of developing importance relative to a larger degree correction or reversal lower in the equity markets is the currently very tight positive correlation between the S&P market, for instance, and the crude oil market. And moving to that, the recent developments in the crude oil, you can see from an intraday 240-minute perspective of the March contract, the March 11 contract, the extent and impulsiveness of last week's setback that initially started with a confirmed bearish divergence in momentum below the 91.17 corrective low from January 14th, and in fact has followed through to break the 88.45 low from January 7th. That clearly exposes at least the intermediate term trend is down and requires minimum strength above Friday's 90.22 high to even stem that sell-off, let alone mitigate the developing prospects of a larger degree correction or reversal lower. And in that regard, we believe the market must now recoup levels above last week's 93.02 high to resurrect the broader bull trend. We have a little bit of a gray area technically as the futures contract has just rolled over from the February contract to March is now being the prompt month, where on a daily active continuation chart basis, the market has yet to break below the 87.25 corrective low from January 7th, required to confirm a bearish divergence in momentum. But as long as at least the short-term intermediate term trend is down with the market sustaining prices below Friday's 90.22 high tightest and last week's 93.02 high, we have to realize the increasing likelihood of this bearish divergence threat that will be confirmed below 87.25 and define last week's 93.02 high as the end of a larger degree wave sequence up and the start of a larger degree correction or reversal lower. From a daily close only basis, you can see the developing importance of the 88, the figure area. 88.03 was a low daily corrective close from January 7th. That entire area was a key area of former resistance, new support, and also a close below that 88.03 level from January 7th would also work in terms of confirming a bearish divergence that would expose a larger degree reverse correction or reversal lower. In sum, by virtue of the extent and impulsiveness of last week's break that we believe threatens both the intermediate, short-term and even intermediate to longer-term perspectives, we advise traders to move to a neutral sideline position, removing themselves, at least temporarily, from the corrective depths unknown of such a larger degree correction lower. And strength above at least 90.22 and preferably 93.02 is required to defer or threaten that peaking and reversal threat that we think is developing as a result of last week's break. Please stay tuned to updates on these and other markets on our rjomrt.com website, and good luck with today's trading.